Hi everyone. Can you hear me and see me well?
Yes, Vasiliki, we can see you.
Okay.
We hear you properly.
Yes, I can hear you very well. If everyone is ready, I can start.
Yes, you can start. You can just do your own intro, so that we don't delay.
Okay, of course. So my name is Vasiliki Ntina, and I'm a research associate at African Private Equity and Venture Capital Association based in London. Today's presentation is structured around two main themes. Firstly, it gives an overview of the African private equity landscape, including information on funds, deals, and exits between 2014 and 2020 first half. The second part of this presentation is focused on the impact of COVID-19 on the African PE landscape, with emphasis on PE activity during the first half of the year. Starting on with the fundraising environment, between 2014 and 2020 first half, African PE firms closed funds totaling $19.2 billion in final closes only. In the first half of 2020, the total value of the African PE fundraising was $0.5 billion from final closes only. The total value of the African PE fundraising, as we can see, fell to $2.7 billion in 2018 and 2.4 in 2017, from 3.4 billion and 4.5 billion in 2016 and 15 respectively, due to several larger funds achieving final closes in prior years. For example, in 2015, funds raised by Development Partners International, Helios Investment Partners, and the Brush Group accounted for 65% of the total amount raised. We see, though, that in 2018, the fundraising environment started picking up, and 2019 actually was a good year for fundraising, as the total value of African PE fundraising revived, reaching $3.8 billion. In 2019, also 24% of the total value of the African PE fundraising was raised from first-time funds. Defining that, first-time funds, it's as an assets manager, first PE vehicle in Africa, which is quite important to see that there was trust in first-time fund managers. Moving on, between 2014 and 2020 first half, there were 1,135 PE deals reported in Africa with a total value of $26 billion. In 2019, the total deal value marked a downward trend since 2016. However, the total deal volume reached its highest since 2014 at 205 PE deals, showing actually that the activity on the continent continues to be encouraged by investors' interest and their commitment to Africa's growth. The increasing also number of early stage investments on the continent last year contributed to that trend. Approximately 1/3, specifically 34% of the total volume of deals in 2019 was in the venture capital space. For example, we had a big investment from the global fund TPG through their RISE fund in Zipline International, a company which designs, manufactures, and operates drones to deliver vital medical products to everybody, no matter where they live. Investments in small and medium-sized enterprises in Africa have been quite stable, despite the macroeconomic challenges that the region has faced over the past few years. However, large investments targeting mainly Africa's infrastructure sector have affected the year-on-year deal values. For example, in 2014, 3 portfolio companies, IHS Towers, Azura Edo, and Helios Towers Africa, accounted for 62% of the total deal value in that year. However, the aggregate value of deals below $250 million tends to be steadier from year to year. Moving on the region's landscape, we see that the geographic diversification of the investments continues to be part of African private equity. West Africa accounted for the largest share of deals by volume, with 24%, with North Africa coming second, while multi-region deals accounted for the largest share by value with 38%. In terms of sectors now, the consumer theme has been dominant for the whole period, with the majority of PE deals being in sectors associated with the rise of the African consumer. Fund managers have also started identifying opportunities linked to Africa's infrastructure gap, rapid urbanization, renewables, as well as information technology sector, amongst others. Africa's investment story is still very much defined by small and medium-sized enterprises, often family-run, operating in sectors that cater to Africa's expanding middle class and the continent's shortfalls in terms of infrastructure development. The private equity story in Africa is driven mainly by the consumer theme and has a large constituent of small and medium-sized enterprises. Actually, investing in Africa's private markets, however, provides exposure to sectors such as infrastructure, healthcare, education, and segments of the economy that are not well captured by the listed markets, such as the small and medium-sized enterprises, and it is therefore better placed to tap into Africa's growth story. Seeing also from the bar chart, between 2014 and 2020 first half, consumer discretionary, consumer staples and financials accounted for 42% of the total deal volume. Communication services, which also includes telecommunications, accounted for the largest share by value, mainly driven by large investments such as IHS Towers and Helios Towers Africa. Going on the exits landscape on the continent, between 2014 and 2020 first half, private equity exits that were 291 private equity exits reported on the continent. The number of exits recorded in 2019 remained stable compared to 2018 with 45 exits. 2018 marked a drop in overall exit activity compared to previous year's high of 52. This was largely due to a fall in the number of exits recorded in South Africa due to a backdrop of heightened macroeconomic uncertainty in the country. In 2019, exits to trade buyers, representing the most common exit route with 43%, a shift, as we can see from the two previous years, where exits to PE and other financial buyers was the most common exit route. Overall, exits to strategic buyers has been the most common exit route on the continent. However, as the private equity landscape is evolving, we see that there is a growing trend of exits to PE and other financial buyers, which emerged in 2016 and persisted in 2017 and 18. Also, as part of our African private equity industry survey, we ask both GPs and LPs, what do they think regarding the exit routes in African PE? Most of the limited partners, 85% of them actually expect exits to strategic investors as well as exits to PE and other financial buyers to increase in Africa over the next 3 to 5 years. In terms of the GPs, 89% of the fund managers expect sales to PE and other financial buyers to increase over the next 3 to 5 years for the same period. Moving on in terms of the regions that we see the most exit activity, South Africa and West Africa accounted for the largest share of PE exits by volume between 2014 and 2020 first half, followed by North Africa. And in terms of sectors, we see as well that the consumer theme is prevalent on the exit sectors as well as on the deals. And financials, industrials, and consumer staples accounted for the largest share of exit volume from the period 2014 to 2020 first half. Now we are moving on to the second part of the presentation regarding the COVID-19 impact of the African PE and VC landscape. As we can see, and as everybody saw that in the first half of the year, many of the trends that affected PE and VC around the world were mirrored also in Africa. However, notable differences were seen between the continent and other emerging markets, as well as within the continent itself. With the notable exceptions of South Africa and parts of North Africa, the region was relatively less affected by the virus than other parts of the world. There were some reasons actually that helped and insulated the continent from the adverse effects of COVID-19 pandemic. First, PE investment in Africa has historically involved comparatively smaller deal sizes, and actually venture capital in particular has seen significant growth in recent years. While growth equity and buyout deals have felt the greatest impact of the pandemic, 2020 saw a large number of VC deals benefiting the financial, software development, healthcare, and education technologies deemed essential during the pandemic. A second important factor that actually helped to insulate the PE and VC is the composition of the institutional investor base with a significant role of development finance institutions. These institutional investors are more likely to have strong environmental, social, and governance measures, factors that should also provide a greater preparation for disruptive events like the pandemic. Additionally, many DFIs have adopted strategies to support fund managers and investing companies in the light of COVID-19 related challenges. Lastly, African fund managers see themselves as taking a more hands-on approach to ensure business continuity and ensure the survival of portfolio companies. Furthermore, given that many African businesses have weathered significant challenges and crises in recent years, many felt they were better prepared to contend with pandemic-induced structural problems and were more prepared to absorb some of the initial shocks to global supply chain and global demands. Moving on, I'm presenting some data specifically for the first half of the year. We see that the total value of the African PE fundraising reached $1.1 billion, including final and interim closes. Of the total amount closed in Africa in the first half of the year by sector-specific funds, 83% was originated from technology-focused funds, such as, for example, Telecom Capital Africa Fund, which closed in the first half of the year at $71 million, targeting technology-enabled companies in sub-Saharan Africa. Moving on to the deals landscape, in the first half of the year, the total value of African PE deals was $0.7 billion amongst 82 PE deals. Looking at the regions, we see that North Africa attracted the largest share of PE deals by volume and value, with 31 and 42% respectively, followed by West Africa. In terms of sectors, in the first half of the year, we see financials, information technology, and consumer discretionary were the most active sectors by deal volume, attracting 49%. With technology-enabled companies representing half of the investments. Healthcare, information technology, and financials were the top three sectors by value, accounting for 54% of the total deal volume in the first half of the year. Actually, healthcare represented 24% of the total deal value in 2020 first half, led by the Mediterranean Capital Partners investment in MetaMed, the largest platform of diagnostic imaging centers in Egypt, Jordan, and Saudi Arabia, along with FMO, DG, Proparco, and EBRD. It is important also to note that 49%, almost half of the number of deals reported in 2020 first half in Africa were early stage. Within early stage deals, information technology was the most active sectors, with financials coming second. Most of the early stage deals in the financial sectors were mobile banking and mobile enabled banking and financial services. Moving on in the exits landscape, in 2020 first half, there were 13 reported exits, which actually marked a drop from the previous year, in 2019 first half, that we witnessed 25 private equity exits during that period. In 2020 first half, PE and other financial buyers was the most common exit route, representing 54% of the total exit volume, followed by trade buyers at 31%. For example, we had an exit from Exeo Capital from Intelligem, a leading provider of crop protection solutions, to strategic investor Massimum Group Holdings. What is also important to note is that the current crisis has created attractive acquisition opportunities as well, aside of the challenges. Renewed economic growth and intense focus on innovation and new technology, as well as the need to adapt to new ways of working and consuming, is reflected in the technology sector investments. Actually, we see a trend forming up from 2014 onwards, and this is also prevalent in the first half of the year. Between 2014 and 2020 first half, there were 296 technology-enabled deals, totaling to $2.5 billion US. Specifically, also in the first half of the year, information technology sector showed an important increase in terms of volume and value, rising to 17% and 16% from 8% and 7% only in 2019 respectively. We can also see that for the same period, fintech companies were the most attractive opportunity within technology-enabled companies after software and services, capturing 15% of the total deal volume. Retailing, as well as consumer services, attracted an important percentage of 17% within technology-enabled companies. This included mostly investments in companies that provide online education or online marketplaces, such as online shopping. We see that the digital transformation can provide notable opportunities for PE and VC investors in Africa, as evidenced by the steady growth of the sector. Moving on, healthcare also was an important opportunity during the pandemic. Historically, the healthcare sector has been attractive to PE investors, likely in part due to the comparatively high rate of return. And we can see also that between 2014 and 2020 first half, there was a stable increase of the healthcare deals on the continent, with 88 deals totaling up to $1.1 billion US. Specifically, in the first half of the year, the healthcare sector, as mentioned before, accounted for the largest deal value with 24%. And actually, in the first half of 2020, the healthcare doubled compared to 2019 first half, where healthcare deals accounted only for 12%, and also was an important increase compared also to 2018 first half, which was only 4% of the total deal value. So, for example, healthcare infrastructure or health insurance platforms that are based on technology and mobile payments, such as Bima insurance, are some of the verticals that can see some more activity in the future. Going on forward, I would like also to point out some of our findings from our industry survey for 2019. And how this showcases that Africa is still an attractive destination, especially in the medium to long term. It's important to note that we asked GPs, and half of the GPs that participate in our survey, 50% of them, expect their African PE returns to exceed 3 times over the next 10 years. And when also we interview limited partners on the specific topic, they believe that the skills and expertise of the fund managers is the factor that is the greatest influence on their Africa PE return. So actually choosing the right fund manager on the continent, the local fund manager with the local knowledge, is really important. And finally, it's important also to showcase what LPs believe. This is from our private industry survey from 2019, which includes LPs that are based on the continent and outside of Africa as well. So actually the percentage of LPs that plan to increase their African private equity allocation over the next 3 years increased to 58% from 53% in AVCA's 2018 LP survey. And also over the a 5-year and a 10-year time horizon, 56 and 59% of institutional investors view Africa as a more attractive market for PE investment compared to other emerging and frontier markets respectively, which is important because African private equity is still is a patient capital. So the medium to long-term expectations of LPs is actually showcasing that it's an attractive market compared to the rest of developed as well as other emerging markets. And that was all from me. Thank you very much. I don't know if there are any questions that I could answer.
Okay. Vasiliki, thank you for the presentation. We've got a couple of questions. Let me just take them quickly.
Okay, thank you, Vasiliki, for a nice presentation. You have painted a nice picture on PEs. I'm left missing all the risks. Okay, so my name is Farai. I'm from Zimbabwe.
Hi, hello.
Okay, so
I have a bit of delay in the sound, so if there is a bit of a gap, it's because of that.
Okay, noted. So I'm saying what you have presented is a nice scope on PEs, but I'm left wondering the risks aspect that you didn't explain. You've said PEs are nice, they cause development, but to me, before we jump to conclude deals with PEs, we need to understand the transparency issues that can arise. For example, the assets they declare versus the liabilities. Number two, the valuation of the transactions. Since they are done at private level, the scope and the actual valuation might not be always to the point. Also, PEs can lead to adverse selection of assets by asset managers. These are some of the issues that I identified coming out from the presentation. But however, I thank you so much.
Thank you. So just to understand, because I don't have the best sound, so your question was about the risks that are involved in the private equity investments. If, for example, a pension fund wants to get involved. Okay. So actually, what we are seeing, what I mentioned also in my last slide, the important thing, of course, we know that private equity or venture capital investments, they pose a risk for investors, for pension funds that are new to this asset class. But as I mentioned in the last one of my slides, the important thing is choosing the right fund manager with the right expertise, the right knowledge, and a manager that has a good track record, that they have done investments in this specific sector. What was important also to note is that, for example, we had interviewed some US pension funds that they were also new as local pension funds to the asset class, and what came out of the conversation, that choosing the right fund manager is the important thing. For example, as they new to the asset class, checking fund managers, for example, that they had investments previous investments from development finance institutions, it would be a good, let's say, first contact point with the asset class. Or working together along with, for example, other pension funds, or co-investing with development finance institutions is a first step to go into the private equity landscape. And as I'm gonna point out again, the right fund manager, choosing the right fund manager with a local expertise or with a good track record is important. I hope that answers
do you have
your
another
question.
Okay, we will take another one. Do we have a question? Oh, you have one here. Okay.
Thank you so much for the nice presentation. Yeah, mine, I think, is closer to what the colleague said. And my name is Matthew from Zimbabwe. I normally notice that normally venture capital investments, if they are directed to startups, the success rates are quite low, around 10 to 20%. So, yeah, we hear you, but I think one needs to be that careful and, like you said, to choose rightly. But maybe higher risk, higher return, I don't know. So you need to carefully do it. And I think you also talked of this new class of assets in fintech. I don't know if that may touch to some Bitcoins and Ethereum. I don't know if it's also prudent to take people's assets which are of long-term nature, mainly retirement and pension funds, to put them in such classes. But you really need to be very careful and be good in investment. Thank you.
Thank you. Yeah, actually, my answer would be closer to the previous one. So yes, venture capital is a risk capital, so riskier than private equity, I would say. However, yeah, as you said, like higher risk, higher return. What we are seeing lately, and it's important to showcase that, especially in the first half of the year as well, there was a huge rise in terms of the technology sector deals. So that actually showcases that there is a trust, let's say in quotes, trust in that specific sector, information technology, because it can be agile, it can be adaptive, it can work in any kind of situation, like we had faced during the first half of the year. And again, like choosing someone after a very careful due diligence and also proceeding along with co-investments is something that can take a bit of, let's say, the risk that is imposed with venture capital investments.
Okay, thank you very much, Vasiliki. If I have any further questions, I will just shoot them your way, because I'm also running very late on my next presentation. So we say thank you very much for making time, and we look forward to engaging with you soon.
You're welcome. Thank you.
Thank you. Let's appreciate her, please. Thank you. Thank you.